Wasi wengi wafikiria ati stock market has nothing to do with exchange rates, and that's wrong. If you have been observant, you can notice that from 2004, mid 2004 to present, exchange rates have been playing around a fixed band. Zimekuwa like mali moja, basically flat hivi. And well, there are a couple of reasons as to why, lakini maybe most importantly kujiuliza ni how do exchange rates affect stock aje, and if there are any changes in your fixed rate, what does it mean for your stock? Alafu another question is, why do we have foreigners and what does it mean for stocks? And then how do you protect yourselves from the dangers ambazo zitoka from foreign exchange? So let's get into it. Just to make it like really clear, imagine where you're a foreigner, where you have like USD, unajaribu kuinvest in the Kenyan stock market. Let's say that you have like $1 billion, and also let's also assume that we are a dollar is going for 100 shillings, right? And then akona that $1 billion amekuja Kenya ikachangewa into 100 billion shillings. Hizo aka-invest in the stock market. And then say imagine our exchange rate itoke kutoka 100 shillings iende 150 shillings. Ni kumaanisha sasa a dollar imekuwa stronger. It buys more Kenya shillings. For the investor mwenye alikuwa ameka dollars, sasa akitaka kutoa hizo dollars zenye alikuwa ameinvest, atatoa less dollars. Kwa hivyo hapo change in exchange rates imemfanya akue like really aende losses. So unacheki like how, especially for foreign investors who are investing in the stock market, and they're like a really big portion of people who invest in the stock markets, and they are really very sensitive to exchange rates. So ukiangalia how our rates zimekuwa tangu 2004, zimekuwa provide like a very stable, I'd say a very stable, imekuwa kipatia like foreign investors confidence ati hatapata losses that come from foreign exchange. So that's like one thing that fixed rates zifanyaga mtu afanye. But the funny thing is that the central bank imekuwa ikisema that we are a floating rate currency. In kumaanisha there's nothing happening to make our Kenya shilling ibaki up at 129. But if you are really like looking at it, I mean, floating rate my ass. I think it's kind of obvious kuna like market manipulations happening, and whether it's good or not depends on where you are when you are at. So for foreign investors, they are really at a good place whereby wakona hiyo confidence that no sudden changes in rates that affect the investments. Sasa, what does it mean for the Kenyan companies? Because being a Kenyan, you don't have any, if you're a Kenyan, you don't have any like how to meet that route of dollars. You have your Kenya shillings, wewe unazipeleka to a broker and you buy stocks, right? So what does it mean for you? I think the most critical point whereby foreign currency in affect your stocks is whether depends on two things. Ya kwanza ni whether the company you're investing in yenye unaenda kubuy stocks from, whether it has any debt denominated in foreign currency. What does that mean? Tuseme your company had borrowed $1 billion kutoka US na inafaa ilipe, don't even consider the interest, just look at the $1 billion imeomba, and then the currency appreciates. Say it appreciates kutoka $1 at 100 and now it's $1 at 150. So that, which means that it will have to, initially ilikuwa imeomba 100 billion Kenya shillings, but now it has to pay back 150 billion shillings. Macheki. So hiyo ni kusema it has like added 50 billion more. Hiyo ni kusema there'll be less money being distributed to the shareholders, and the stock will go down. Everything else ikiwa constant, the stock will be undesirable, watu watauza, and it will not be a good thing. So that's the first way that foreign exchange it affect the markets. So the second one, now this is also as important, ni kuna there are these companies ukaangalia the NSE list kutoka banking, kina KCB, kina Equity, Telecom, Safaricom, Energy, Power. So there are various companies in various sectors, and some of them need to import things kutoka majuu. Others, they need to export things kutoka majuu. So you might have already gotten the gist of how things zina work with foreign markets. So if the Kenya shilling inakuwa stronger, then mtu alikuwa na export itakuwa anapata less income in terms of Kenya shillings. Maybe if you look at this, someone who was importing, wewe ni company kama KPLC, let's say, na ulikuwa na import a transformer at $1. Let's assume $1, and then you are paying like 100 shillings, right? You're paying 100 shillings for a transformer. I know let's make it simple. You're paying 100 shillings, and then sasa the exchange rate imekuwa such that $1 equals to 150 shillings. Hiyo ni kusema utakuwa unalipa 150 shillings, ndio ikienda majuu it's $1. So when you see the currency has depreciated, then importing becomes harder. The opposite thing it'll happen when the currency becomes weaker. That's why unasikiaga like China inaekelewa that it's making its currency weaker, because that makes like exports very cheap. You know, that's something with countries that export a lot. You hear them being accused of manipulating their currency to make it weaker so as to encourage exports. So if a company sasa it's like exporting a lot due to a weaker currency, that also has an effect on its bottom line. Same like a company kama BAT, which like exports like 50% of the revenue imetoka outside the country. When the currency gets weaker, kumaanisha it might export more, its revenues might grow. So that's currency uko like a very important thing. Na sijui mbona like watu wapenda kuignore. So we're going to look at how do you protect yourself against easy changes in currency. And if you're liking this video up to now, you can hit that like button and check him. Tuseme uko na stock and then you hear that suddenly hii rate tulikuwaga nayo imeanza kupanda juu, so dollar imeanza kuwa stronger, the Kenya shilling imeanza kuwa weaker. I hope you have a clear idea now as to how the stock market is likely to react, how it is likely to react if the number of foreign investment in our stock market is large, and also what it means for the companies in the NSE that import and export stuff. So kuna like this, you hear that a country imefanya capital controls. What that basically means is that there is no free flow of capital kutoka like majuu kukuja Kenya ama kutoka Kenya kwenda majuu. You hear that countries are doing that, and maybe you're wondering why do countries do that, and how does it even relate to the stock market? Ukiangalia sasa kitu kama our stock market, when foreigners buy stocks in our stock market, those are basically free capital flows. Now that usually affects our currency, because if you hear that the more capital is coming in our country, the stronger our Kenya shilling inapanda due to high demand of it. I think the biggest danger with free capital flows ni ati companies that really that borrow kutoka majuu in dollars, because interest rates kutoka majuu, they're cheaper than interest rates in Kenya. Ni ati it might become harder in the future to repay, which sort of presents a very dangerous problem, because if a company iko at risk of not repaying a debt because exchange rate imechanganyika and they have to pay more, that's going to be like a danger for local companies. So yeah, those are the ways in which the currency market, that's foreign exchange, interacts with the stock market. I hope this was valuable to you, and I hope if you're interested in kuona how there is an inflation threat in Kenya, you can check this video right here.